Dumelang. It has been a while. And today I just want to talk about the break-even point. One of my grade 12 asked me to make a video on this. So we'll start by explaining what a break-even point is. So a break-even point is a point where the entity neither makes a profit nor suffers a loss. So when they say you have broken even, they mean that your income is the same as your expenses. So you didn't generate any profit and you did not suffer any losses. So at break-even point, when you take your income and you minus your expenses, you will get zero. Meaning that at break-even point, your income is equal to your expenses. And as I've said earlier on, it means that at break even point, the entity has produced enough to cover for its expenses, or to be more specific, to cover for its fixed costs. To make profit, the entity will be required to produce units that are more than the units produced at break-even point. So you need to understand break-even point is in units. It is in units. Now, let's say this is our break-even point. Now, if we were to do a scale, it means that for this to balance, your income from selling must be the same as your total production cost. That is what break-even point is. At break-even point, as I've said, you have produced enough units to cover for your fixed cost. Right? Now let's explain what are these fixed costs. We'll explain fixed costs, variable costs, and the contribution. So what are the fixed costs? Fixed costs, these are costs that do not change, that is increase or decrease irrespective of the increase or decrease in production. So they remain constant. Whether you produce more or you produce less, they remain constant. That's what fixed costs are. Now, what are examples of these fixed costs? Let's say we have rented our factory space and we are paying 10,000 Rand per month for that factory space. Whether we are producing or not, we still have to pay that 10,000 Rand. And for rates and taxes, whether we are using that property or not, we still have to pay for rates and taxes. And obviously, rent that the entity pays for its factory will remain constant, whether more units or less units are produced. Other examples will be your depreciation of factory assets. So whether you're producing or not, your factory assets will depreciate. And as I've said, rates and taxes and salaries and wages that you pay your employees, whether you're producing more or not, if you have a factory supervisor, that factory supervisor still has to be paid. Okay. All factory overheads are considered to be fixed costs. So we're talking about rent, we're um, talking about, as I've said, rates and taxes, water and electricity, all of those. I mean, it doesn't mean that if you're not producing, the factory can't be using electricity. So we still have to pay for that. It's fixed, all right? And then we've got variable costs. Variable costs, these are costs that do change. So they increase or decrease due to the increase or decrease in production. For instance, if I am producing goods, one of the things I will need to produce those goods will be my raw materials. So I'll buy more raw materials if I produce more, and I'll buy less raw materials if I produce less. So my direct material cost will increase as more units are produced and will decrease as less units are produced. For example, as well, if I need people to produce, more people to produce, I will hire more people, and that will result in my increase in direct labor. So yeah, the higher the production, the more employees I will need. And when I hire those employees, I will have to pay them. That will increase my labor cost. Normally, employees that are involved directly in making the product, they normally call them casuals. Casuals, yes, I think they call them casuals in a normal lingo. And that means that they will get rid of you if they don't need you, and they will hire you if they need you. So if production drops, they will just fire you. And if production increases, they'll call you up again to come and work. So that's why you get paid wages. That's why they call them casual workers. They are not permanently employed by the business. And as I've said, that's what will happen with your labor cost as production increases. And yeah, that'll be it. All right. Similarly, with your selling and distribution. Okay, selling and distribution costs will increase the more you produce because you will sell, and the less you produce, they will decrease. But your administration, which is that office clerk, um, their wages will actually not, their salary will actually not be affected by production. So they will be fixed. All right. So fixed means that that cost does not change irrespective of whether we are selling or producing more. Now, prime costs, as I've said, are considered to be variable costs, including selling and distribution costs. And administration and overheads are considered to be fixed costs. Now, we've got selling price per unit. It is the selling price for selling each unit. Okay. So if I am selling laptops for 5,000 rand, so one laptop will be 5,000 rand. And if I want the total laptops, total selling price of 10 laptops, then I'll take 5,000 rand and multiply it by 10, which will be 50,000. But when we talk about selling price per unit, if I'm giving 50,000 as my sales amount, and they told me that to sell each laptop, I sold it for 10,000 or 5,000, I will simply take that 50,000 and divide it by 5,000, it will give me 10. So it'll simply, actually, I will take that 50,000 and divide it by 10, it will give me 5,000, which is the selling price of each laptop, right? So that's how you will get selling price per unit. It is the selling price of each unit, all right? Not all unit, but of one unit, of each unit, all right? As I've said here, let's say we sold 200 units. So if we sold 200 units and they amounted to 20,000, if I want the cost price of each unit, I'll just take that 20,000 and divide it by 200. That will give me 100 rand, which is the selling price per unit. Then we've got variable cost. Variable cost per unit, it's simply the variable cost of producing a unit. Now, if I've got variable cost of producing 15 units is 1,425. If I want the variable cost per unit, I'll just take that 1,425 and divide it by 15, and that'll give me 95. So 95 will be the variable cost per unit. Now, contribution is simply your selling price per unit, or it's just your selling price minus your variable cost. Okay. So if I want contribution per unit, I will just take my selling price per unit and then minus my variable cost per unit. That's how you get contribution per unit. It is just the selling price per unit minus variable cost per unit. That's it. Now, to calculate your break-even point, you just have to follow the following steps, right? Understanding is so important because once you understand, everything becomes easy. So basically everything that I wrote here is the things that I wanted to say. I just put them in slides instead of saying them. I write them down so that because I know that if you didn't hear what I said, at least you can read what I wrote on the slides. And one thing, the first thing that you will need when you calculate break-even point is your total fixed cost. Step number one. You need to have your fixed cost. Step number two, You need to calculate a selling price per unit and the variable cost per unit. Per unit. Not for everything, per unit. Step number 3, calculate what we call the contribution per unit. And how do you calculate contribution per unit again? It is the selling price per unit minus variable cost per unit. So you need fixed cost, then you find your selling price per unit, then you find your variable cost per unit, then you calculate your contribution, which is your selling price per unit minus your variable cost per unit. And once you got your contribution, you can now calculate your break-even point. Just 4 steps, guys. And your break-even point is just your fixed cost divided by contribution per unit. And whatever value you get as break-even, it's in terms of units to be produced or sold for you to not suffer a loss or even make a profit. So it's just zero, where your total income is equal to your total expenses. So whatever you get as break-even must be in units. It is in units. Please note that the break-even point is in units. That's it, guys. I was doing a paper with my grade 12 and they were saying that when you do it, it looks so easy. Um, it's because it is easy if you just listen to everything that I say and you pay attention. Everything, trust me, will be quite easy for you. Okay. And I tried to look for questions on break even from past papers, and I must say that I struggled, especially IEB people. I really struggled. They don't ask this that much. I don't know why they don't ask it that much. Um, I just do it in case it comes out because I know it will be around 4 marks, 5 marks. But they hardly ask it. I don't know why. Um, I think it's because it's quite easy anyway. Here we've got selling price per unit, which is 500. Fixed cost amount to 25,000. Variable cost will be 250 per unit. We need to calculate how many units need to be produced to break even. That's why you're going to follow those steps that I gave you. The first thing that you need is your fixed cost, of which we've got, which is 25,000 Rand. And then you calculate your selling price per unit, which is given to you here. Okay, so sometimes they'll give you your sales and then they'll tell you that you sold 200 units. You just take your sales divided by 200 units to get your selling price per unit. And then your variable cost as well. Normally they will give you your administration cost, your total administration cost, and then they will give you probably your um prime cost, total prime cost. Obviously, for prime cost, you will divide it by the number of units produced, right? And that's how you will actually, did I say administration? Not administration, guys. It is selling and distribution. And your distribution costs, you will divide them by the number of units sold, because selling and distribution. So if you want cost per unit, you divide it by the number of units sold. Prime cost. Prime costs are for producing. So you will divide the total prime cost by the number of units produced. And then you add the two to get your variable cost per unit. Okay. That is if I've checked with, I don't go to that extent. I know that with DBE, they do go to that extent. Now, if I have my variable cost, step number 3 requires me to calculate my contribution per unit, which will be 500 minus 250. And 500 minus 250, which is the selling price per unit minus my variable cost per unit. And that'll give me 250 as my contribution per unit. Now, this is all I have. Now I can just quickly go to the last step. The last step wants me to calculate my break-even point. How do I calculate my break-even point here? I've got my contribution, so I'll just take my fixed cost and divide them by my variable cost per unit. It's simply your selling price per unit minus variable cost per unit, which is your contribution per unit, of which we calculated. So our fixed cost here amounted to 25,000 and our contribution per unit will be 250. You divide the two, it'll give you the number of units you need to produce to break even. Now, if you were to break even, you need to produce or sell 100 units. Okay, produce and or sell 100 units. Now, if you really want to make profits, you have to at least produce 101 units. And that will result in you having a profit. Okay, that profit will be that 1 unit that you produce, 1 unit extra you produce. But if you produce 99 units, you are going to make a loss, 1 unit loss. Now, as I've said here, this means that the entity must produce more than 100 units in order to generate profits. If the entity produces less than 100 units, it will make a loss. That's how easy it is, guys. Okay. Let's go to this one. That's what I'm saying. Like they hardly ask this in IEB. Probably in DBE they do ask it a lot. I'll look at DBE papers and come up with more examples from DBE. So this is one that I got from the IEB November 2021. It says the following break-even calculation was done at the end of the year. It took into account administration and selling and distribution expenses. As I told you, administration and factory overheads, those are fixed. Selling and distribution and prime costs, those are variable. So they were also taken into account here. Now, what is that 1,020,000? That is your fixed cost. Brilliant. And then what is that 525? It is the selling price per unit. And what is that 3,400,000? That is the total variable cost. What about the 12,500? It's either the number of units produced or sold. Okay. So if you want variable cost per unit, you will take total variable cost, which is that 3.4 million, and divided by the number of units produced or sold, which is 12,500. So that will give you a variable cost per unit. So this over here will give you a variable cost per unit, right? This here, it's your variable cost per unit. And as I've said, that 525 will be your selling price per unit. What is that 6,892 units? It is your break even. So you need to make sure you produce or sell more than 6,892. Because if you produce less than that, you are going to make a loss. Okay. So the question, what does the question say, basically? Here is the question. Okay. I don't know why I didn't write the question here. But the question was asking if everything remains constant. If everything remains constant, okay, and your break-even point is 5,000 units. If everything remains constant and your break-even point is 5,000 units, I just had to include that. It says that assume that there are no changes to any of the costs in the break-even calculation. Now, determine the amount the business will need to sell 1 drum at in order to break even at 5,000 units. Now, what they're saying here is that we need to determine, they're giving us the break-even point, but they are not giving us the selling price, but everything remains the constant. So those fixed